A lot of investors are wondering whether the market is getting ahead of itself, especially in AI and tech. Hi, I'm Rob West. But what if the better question isn't whether we're in a bubble, but how should we respond if we are? Mark Biller joins us today to talk about what investors should do when markets look overheated and why trying to predict the exact peak usually backfires. Then it's on to your calls at 800-525-7000. That's 800-525-7000. This is Faith and Finance Live, biblical wisdom for your financial decisions. Well, what a treat to have my friend Mark Biller with us today. Mark is executive editor and senior portfolio manager at Sound Mind Investing, a faithful underwriter of this program, and that's been true for a long, long time. Sound Mind Investing has helped for decades believers make wise, biblically informed investing decisions with clarity and confidence. Mark, always a treat to have you here. Thanks for stopping by.
Thanks, Rob. Great to be with you again.
Hey, let me mention, folks, that Mark will stick around for the entire program today. So this is your chance. If you have questions related to the markets, your portfolio, what's the right allocation, maybe you've been on the sideline wondering, do you dare enter this market? Maybe you have questions about, I'm sure you do, SpaceX. Should you be an investor? Any of those questions are fair game today. 800-525-7000. That's 800-525-7000. You can call right now, and we'll begin taking those calls here in just a moment. Now, Mark, let's dive into this topic today. It's an important one, and it's on the minds of a lot of our listeners. And you have a really timely article in the latest SMI newsletter on how investors should handle a potential bubble. And there, of course, is a lot of chatter right now about whether AI and tech are getting overheated. Just give us a sense of what's fueling those concerns.
Yeah, sure, Rob. So the AI story has been increasingly driving markets for really about 3 years now. We can see that really clearly if we compare the performance of the tech-oriented NASDAQ index, which is up about 160% since the end of the 2022 bear market, to the broader S&P 500 index, which has done great. It's up about 120% over that same period, but still the NASDAQ tech stocks have done quite a bit better than the broad market. Then more recently, we just finished an earnings season this spring where a lot of companies showed profit acceleration that they attributed directly to AI. That was a little bit of a wake-up call, showed that the AI story is real, that a lot of companies across many different industries are starting to cite that AI benefit to their bottom line. And by extension, that kind of gave a pretty clear impression, those earnings calls did, that companies are going to be demanding a lot more AI, a lot more computing power than we currently have, and that whole narrative just sent everything related to AI just soaring. Now, at the very center of that story, you've got the semiconductor stocks. They've gone parabolic the past few months, just almost straight up on the chart. And whenever investors see a sector do that, they naturally start getting a little nervous because it brings to mind past blow-off tops that ended eventually with sharp declines.
Yeah. So in your view, are these concerns warranted? I mean, are we really looking at a bubble, or do you think there's something different going on beneath the surface here?
Well, first of all, it's always hard to call a bubble in real time, or at least to identify it in a way that's really helpful to anybody. If we think back to the last big tech bubble in the late 90s, there were a lot of people that suspected internet stocks were overheated, were in a bubble, and probably the best known example of that was when Fed Chairman Alan Greenspan famously said that the market was irrationally exuberant at the time. That was right. We were going into a bubble. The problem, Rob, was Greenspan made that comment 3.5 years before the market peaked. So we had a long way to go before that really materialized.
Yeah, really interesting. Well, we're going to continue talking about this when we come back from this break. We'll talk about, the legitimate innovation and growth beneath some of the excitement. We'll talk about how we avoid reacting emotionally. We'll talk about even some practical steps we can take right now if we're feeling uneasy about the market without reacting in fear, and plenty of your questions as well. So this is the day. If you have questions related to the markets, your portfolio, Mark Biller's here. He's ready for them. 800-525-7000. We're just getting started. Stay with us. Thanks for joining us today on Faith and Finance Live. I'm Rob West. We're talking about how to handle a market bubble today. Are we in one? Well, as Mark Biller said, our guest today, it's very hard to tell when you're in the middle of it, but there are some lessons we can learn from the past. There's some timeless wisdom in God's Word that we can apply. Wise investors don't have to ignore market risks or be ruled by them. We want to be disciplined and diversified and long-term and respond with wisdom rather than react out of fear. Mark and his team have written a great article on this topic that you can access at soundmindinvesting.org. It's there again at soundmindinvesting.org. Just look for how to handle a bubble when you get there. Again, that website, soundmindinvesting.org. We're also going to begin taking your calls and questions in just a few moments. So if you've got a question today, something specifically on the markets or your portfolio, Mark will be taking those calls in just a bit. 800-525-7000. You can call right now. Again, that's 800-525-7000. So, Mark, I think suffice to say what you were saying before the break is, it's entirely possible we could see a bubble forming in, say, the semiconductor stock specifically, correct?
Yeah, that's definitely possible, and even maybe more, making it more complicated, Rob, you could have a little bubble forming in those stocks without the rest of the market necessarily looking particularly bubbly. I guess the big thing that I'd want listeners to understand, sometimes it feels kind of random why stocks move the way they do, but in this specific case, the past couple months, you've got a pretty clear vector here. The stock market is always forward-looking, meaning investors care a lot more about what companies are going to earn in the future than what they're earning today. So when you go through an earnings season like we just did, and those future expectations improve dramatically, that's a pretty clear line that says that stock prices should go up. And so that's what's happened. And a lot of that enthusiasm is really backed by genuine earnings growth, not just of the companies providing the AI, but the broader industry of companies that are applying AI to all of their hundreds of different businesses and seeing a beneficial impact. So that's really kind of the story behind this recent market advance.
And investors are taking note and realizing this isn't just somebody adding .com after the struggling business's name, right?
Yeah, that's so key. Back in the .com bubble, you had a lot of companies that were getting a lot of hype that really didn't have any earnings. And the difference this time around, especially this recent earnings season, has been these are companies that everybody knows that have been running normal, profitable businesses forever, and they're saying in call after call after call, hey, this is how we're applying AI and getting a benefit and seeing our profits increase because of these tools. And so it was kind of a little bit of a wake-up call to hear so many companies kind of saying the same message, and that's really what got investors excited.
Yeah, really interesting. We're going to continue to move through this topic today. We're going to talk about how you should think about this idea that there may be very real, legitimate forces behind the rally. That doesn't mean we can ignore the risk. And Mark will give you some thoughts on how you can proceed and invest in a way that's wise and not emotional. We also want to take your calls and questions today, 800-525-7000. Questions on the market, your portfolio, the economy. We'd love to hear from you. Again, lines are open. Mark Biller here today, 800-525-7000. Let's begin in Florida today. Alberto, go ahead.
Yeah, Rob, how are you doing, sir?
I'm great. Thanks for your call.
All right. I just got a question. I recently opened a Fidelity Go Roth account, and I'm not liking the way it's actually performing. I have it at moderate with income.
Okay.
I'm wondering what's the best for me to set it at.
Yeah. What is your age and what is your goal for this money? Obviously, you said it's a Roth, so it's long term, but what does that mean for you?
Well, not paying taxes at the end of the year or when I retire. So I'm.
And how far off is that based on what you know today?
I'm going to be 66 in July 1st.
Okay.
So by next year, July, I have to start collecting Social Security, and I'm trying to build up a little income because I have bad knees, unfortunately, and the type of work I do is not the greatest. It doesn't let me walk very well. So I'm trying to retire. I have another account. There's like $30,000 in there from the company I work for, which is Nova Southeastern University.
Oh yeah.
And I'm gonna keep that rolling for a while, maybe a year or two, and still work for maybe a year. But I'm a little concerned with this Fidelity Go because it's not been performing very good for me. So I'm just wondering where to set it at, where it can perform. I can see some results.
Yeah. So Mark, just robos in general, and then secondly, for somebody who's in this situation of Alberto, how should he think about that, especially with so much of the market growth coming outside of an income-oriented portfolio, at least in the aggregate?
Yeah. So, Alberto, the tricky thing with any kind of automated investing system like these accounts is you kind of have to translate the words into what exactly you're investing in. So moderate income, I don't know exactly how Fidelity translates that, but you can certainly, I would think, go into that account and figure out, okay, is this roughly what percentage in stocks, what percentage in bonds, and then potentially make an adjustment to which level or category you are invested in based on whether you like that allocation or not. Generally speaking, for somebody who's in that 66-year-old kind of early retirement years, that type of age frame, the normal conventional wisdom would be for that portfolio or for that investor to invest roughly evenly between stocks and bonds, 50-50 or something like that. So you can compare that to what this moderate income portfolio is doing. It is true that recently interest rates have been on the rise. So when interest rates go up, a lot of income-producing investments, including bonds, tend to not perform very well. So that could be part of what's going on. I think that the big thing is looking at that overall allocation. I would probably, encourage you to have at least, 50% of that money invested in stocks. And personally, I like, even within the bond side, diversifying that a little bit to maybe include some gold, precious metals, commodities, that sort of thing, just given that in an era of rising interest rates, it's hard for bonds to perform really well. And we've seen that over the last 5 or 6 years where overall bond returns have been pretty flat because those rising interest rates are a headwind to bond returns.
Yeah. Each notch you turn that dial toward a more aggressive portfolio is going to add more stock. So, right about in the middle, you're going to be 50-50. If you dial that up toward one slot more aggressive, that's all of a sudden going to put you at a 60-40 stocks to bonds. So that's what it's going to come down to is what kind of stock allocation, what kind of bond allocation. Mark's saying at your age, 50-50 is right as a starting point, but you could get more aggressive or more conservative from there. And, bonds have not done great in this recent past. Thanks for your call, Alberto. More to come after this.
The opinions offered during this program represent the personal or professional opinions of the participants, given for informational purposes only. Any information provided is not intended to replace advice from a financial, medical, legal, or other professional who understands your specific situation.
Great to have you with us today on Faith and Finance Live. I'm Rob West. Mark Biller's here today. We're talking about bubbles. Are we in a bubble with AI and tech? Well, Mark said there's a lot of legitimate forces behind this rally, but that doesn't mean we can ignore the risk. So in light of that, and by the way, we'll be headed back to the phones here in just a moment. So if you have a question for Mark Biller today, call right now, 800-525-7000. Mark, how should we think about this tension between legitimate rallies and the risk that's present?
Yeah, it's a tricky thing, Rob, and that's really what this article we're talking about is focused on. It's actually not trying to prove one way or the other whether we are or aren't in a bubble currently, because we think that the better question really is, what should wise investors do even if markets have become overheated? It's not like you can just necessarily sell everything and move to the sidelines. That's not a good plan. One of the biggest lessons from history is that trying to predict exactly when a bubble or even just a long-running bull market is going to end usually doesn't work very well.
Yeah, exactly right. And so that's something we just need to be on our guard about. There is also, though, this emotional side of this thing with regard to not acting out of fear. And it does get difficult because, emotionally, we want to avoid the downturn without missing the upside, right?
Yeah, we sure do. It's hard on both sides, right? It's hard during a bear market when we get really fearful and we extrapolate that markets are going to go down forever. And it's hard during a bull market like right now where we extrapolate that the good times are going to last forever. In practice, any relationship to those types of thinking tends to move you towards market timing, and that's just extremely difficult. Investors typically wind up either selling too early and missing out on big gains at the end of a bull market, or they're selling too late after stocks have already plunged and fear has completely taken over. So what we're trying to emphasize at SMI is, how do you stay invested while still managing your risk in a thoughtful way, knowing that a lot of the time the market's biggest gains do come late in the bull market, right before the end when things cool off?
Yeah, that's really helpful. We're taking your questions today for Mark Biller, 800-525-7000. You can call right now. Let's head to the phones. Tanya's been waiting patiently in Chicago. Go ahead.
Hi, Mr. Biller, and hi, Mr. West. My question is pretty simple. You can disconnect me and answer it. I just wanted to know, with respect to investing with my grandson, $1,500 or $2,000. It's not a lot of money, but I don't want to crush his interest in the market. So should I just put it in a high yield savings? I trust you, Mr. West. Is there someone that you could recommend me to talk to so that myself and my grandson could have a better understanding with respect to investing?
It's a great question, Tanya, and I love the way you're thinking about this to get this, moving in the right direction, get it growing for the future. You can, teach your grandson some things in the process about investing, but then ultimately have something that could be really helpful and valuable for him at a key point in the future that you think it's appropriate to hand it off. I want to send you a copy of the Sound Mind Investing Handbook just as our gift to you, and I think that would be a great way for you to begin to learn some of the terms and just how to approach investing in general. And then the SMI newsletter could be a great resource for you at soundmindinvesting.org, because they'll actually give you the actual mutual funds to pick, and perhaps their strategy called Just the Basics would be a great starting point for you. But Mark, what would you share with Tanya to get her started today?
Yeah, there are a lot of different ways to go with this, and some of it has to do with whether you're trying to use this account to help teach the grandchild, a little bit about investing, or if this is really just kind of, trying to get money aside for their benefit. To the degree that you're wanting to involve a child or a grandchild in the investing process, help them make some of the decisions, those sorts of things, have those discussions, then you might go a little bit different direction, whereas there are some other options like the new Trump accounts that can be opened that are very basic. They're invested in index funds, so there isn't a whole lot of choosing of what to do with those. And those function a little bit like an IRA for a young person. So, those can be a good option with a grandchild that I think you said was 15. I believe they'd qualify for these Trump accounts that are a new thing. Those are a couple of thoughts. But, there are always the custodial accounts that have been around for a long time where you open it up, it's in the minor's name, but with your name on there as well, and you're making those investment decisions. So there are a couple different ways you can go with that.
Is that helpful, Tanya?
Oh, yes, I thought I was disconnected. Oh, yes, sir. I was just listening. Yes, sir. So I like the idea about the Trump accounts. But once again, to answer your question, Mr. Biller, it's a twofold. Both hopefully he'll get a few dollars out of the deal, but the main thing is just having him to have an understanding that I didn't have growing up, and I'm still not good at it. So I just want him to be well versed in investing, if that makes sense.
It makes a lot of sense, and I think you're on the right track here. I want you to hold the line, Tanya. We're going to send you a copy of the Sound Mind Investing Handbook. That's going to get you started. The Trump accounts could be a great option. Also, check out soundmindinvesting.org. The Sound Mind Investing newsletter could be a great resource, not only for education, but actually to help you pick those mutual funds for that account that you set up for your grandson. God bless you. Thanks for calling. We'll be right back with Mark Biller on Faith and Finance Live. Stick around. Thanks for joining us today on Faith and Finance Live. I'm Rob West. Well, as we've said, wise investors don't have to ignore market risks, but they also don't have to be ruled by them. Mark Biller is Senior Portfolio Manager at Sound Mind Investing. You can learn more about this topic we've been covering today about market bubbles when you head to soundmindinvesting.org. Just check the article, How to Handle a Bubble. We're also taking your questions today at 800-525-7000. Let's head to North Carolina. Joanne, what's your question for Mark today?
Thank you for taking my call. My question is, I have a TSP account at work, and I have been very safe throughout the years. 15 years I've invested, but I've not been in anything that has risk. And with the market looking as it's been looking and seeing the profits that some are making, I'm thinking about taking maybe 10% of that and moving it out of the G fund into something that might get a better return. Any suggestions for that?
What did you say your age was, Joanne?
I'm ready to retire in a year and a half. I'm 68.
All right. And at that point, would you begin drawing out of this TSP, or would it just continue to grow?
It's going to continue to grow. I'm not planning to pull out of that at this point.
So you'll be living on Social Security or something else?
Yes, Social Security and something else.
Okay, got it. Yeah, Mark, what are your thoughts?
Yeah, Joanne, whether it's the thrift savings plan or a 401k or even non-retirement accounts, the key is always trying to look holistically at all of the money that you have invested and then figure out how that should be allocated between riskier investments like stocks and conservative investments like bonds. And so it sounds like you've got most of your money in very safe, U.S. Treasury type bonds, and that's fine. But if you don't have any stock investments, I do think it's probably appropriate to have at least some exposure there. Generally speaking, retirements last quite a while these days, and so you want to have some investments that give you the opportunity to outpace the rate of inflation with your savings. Within the thrift savings plan, there are really three options that are stock focused. You've got the C fund, which are large company U.S. stocks. The S fund are small company U.S. stocks. And then the I fund are foreign stocks typically. And so moving some of that money into the C fund and maybe a smaller amount into the S and or I funds, that's certainly appropriate. Again, for someone in roughly early retirement age range, targeting somewhere around a 50-50 split between stocks and bonds is usually kind of the conventional wisdom. Now, if you're coming from zero stock exposure, that may feel like a big jump, and there's nothing that says you have to do that all at once. So you could, make incremental moves from the G fund and expose a little bit more to the stock market at, different intervals. That also protects you just a little bit in case the market does go down temporarily right after you make a move like that. That can be pretty discouraging. So a lot of information there on our website. If you search for Thrift Savings Plan, we have some articles specific to the TSP accounts and how to use those. But those are my thoughts.
Very good. Is that helpful to you at all, Joanne?
That is helpful. I've just been waiting, trying to decide which way to go with it. I do have some investment in gold and some investment in silver, so I'm a little diversified in some things, but not as much as I'd like to be. So Thank you for that information regarding my definitely account at work that I've been putting in all these years. I'm ready to see a little bit something with it.
And I think the key is that the TSP makes it really simple to do it. So anytime you want to dial up any kind of stock or bond exposure, it's pretty easy to do. The stock gives you a few more options because you've got to have the common, and then you've got the small and the international. But between the three, if you whatever portion you decide to put in stocks, maybe half in the C, and then split the other half of the stock portion between the S and the I, something like that could be great. And then just make sure you have at least a 10-year time horizon, if, based on what you know today for that portion. But it doesn't mean that, you couldn't access the other portion sooner if you needed it for something unexpected. And obviously the whole thing's available to you if you need it. But the goal at least would be to let that continue to grow, because we don't want to try to pick where the market's going in a short period of time. Joanne, really appreciate your call today. Lord bless you. Let's go to Dalton, Georgia. Mark, go ahead.
Yes. I don't know what information she gave you, but I'm 76, semi-retired pastor, and no debt. We have a couple of rentals, and income's not a question, but we've done very well with my wife's IRA, and it's grown to a little over 100. We don't like the up and down of that, and I've had some recent health issues. She wouldn't want to, manage a lot. We have diversification with retirement, Social Security, short-term annuities, and CDs.
Excellent. Mark, your thoughts for Mark?
Yeah, so Mark, is the main question here, how do we kind of de-risk that IRA, or what are you hoping to accomplish here?
It's very balanced, with American funds. There's actually, I think, 4 funds that we are invested in. We actually have very little in it by our contributions, but of course the market has done very well.
Uh-huh. Yeah, I mean, there's nothing that I'm hearing that is raising any alarm bells. So I guess, I'm trying to determine what really are you hoping to accomplish here? What's the core of the question that you're asking us?
The main part of that is should we do something else? We're both 76. Should we do something else with the IRA where there's not the market fluctuation? I mean, when it goes down $5,000 or $6,000, it's great when it goes back up, but that's a pretty good hit on a little over 100.
Yeah. Yeah. Well, I think that, again, thinking holistically about all of the investments that you have, including the rentals, which are, more income oriented, it's certainly not probably inappropriate to have some stock exposure, but you can always, if you're meeting your budget needs with the income that you have, that does make it a little bit more optional how you want to invest that additional money in the IRA. And if you want to throttle down the risk, the easiest way to do that is probably just to adjust the mix of mutual funds that you own already within the IRA and take a little bit out of the stock-focused funds. And if you have some bond-focused funds already in that mix, you could just add to those. If you don't, you can likely easily add those by contacting the custodian of the IRA.
Excellent. Mark, thanks for your call today. We appreciate you being on the program, sir. All right, we're going to take our final break of the afternoon. When we come back, Mark Biller will be here. We'll talk to Ethan in Wisconsin, Ray in Austin, and we'll talk about SpaceX. I'm sure there's some questions out there related to whether or not that's something we should get anywhere close to. I know we've heard from a few folks already, and there's been some real momentum there with that company. We'll get Mark to weigh in on that straight ahead. If you want to check out this article we've been talking about, it's called How to Handle a Bubble. You'll find it at soundmindinvesting.org. We'll be right back with Mark Biller. Stick around. Great to have you with us today on Faith and Finance Live. We've got room for maybe one or two more questions today for Mark Biller. If you have a market-related question, call right now, 800-525-7000. Let's go to Wisconsin. Ethan, go ahead.
So me and my wife, I'm 26, my wife is 27. We just inherited roughly like $250,000 in cash, like that's cash value. We are not exactly sure what to do with it. We are going to fully fund both of our Roth IRAs. We're going to do Trump accounts with our 3 children if they're eligible. But then we're wondering just what we should do with the rest of the money. We live very cheaply, but I finished an accounting degree in the fall. So I'm going to be making decent money, like $75K once I get out. We're just wondering what I should do, like what we should do with the money for the long term.
Yeah, very good. Mark, your thoughts?
Yeah, I love it, Ethan. That's a great situation to be in. What an awesome problem to have. I like the ideas that you've already expressed, the Roth IRAs, the Trump accounts for the kids. If you want to prioritize, the kids' future savings, of course, you have things like 529 plan accounts available for saving for college, that sort of thing. If you want, a very viable path would be to open up a taxable brokerage account wherever you have your Roth IRAs, invest that money for yourselves in the taxable account, and then use that account to fund future Roth contributions so that you can essentially be rolling that taxable money into Roths year after year after year to get more of that on a tax-advantaged basis. But you could basically invest in a very similar way within the taxable account to what you're already probably doing in the Roth accounts. So those are just a couple of little tricks to eventually tax advantage more of that money over time, if that's your goal. And that also, of course, keeps it available to you in that taxable brokerage account in case things like buying a house or, any of life's steps that you run into as a 26, 27-year-old, that money is readily available to you.
Yeah, Ethan, is that helpful?
It is helpful. One more question. We don't have any debt or anything like that, but we rent. Is there anything that we can do that sets us up well to buy a home in the future?
Yeah, Mark?
Yeah, I mean, having that cash, on hand does put you in a position, whether you're buying soon or down the road, you can kind of look at that as shaving the house price down by a considerable chunk in order to get a mortgage that fits within your budget. In other words, if you buy, a $400,000 house, but you have $100,000 cash from this inheritance, it's as if you're buying a $300,000 house in terms of calculating what that mortgage payment is going to do to your budget. So that can be a tremendous leg up and give you some flexibility maybe to get into a house sooner, or at least to be maybe looking in a slightly different price range. Of course, you don't want to blow out your budget just because you now have cash on hand. But, you're about to be a CPA, Ethan, it sounds like, or an accountant. So hopefully you can find that balance of staying within your budget, but utilizing this very big leg up that gives you some flexibility that a lot of folks don't have.
Yeah, very good. Ethan, we appreciate your call. All the best to you and your wife and your plans ahead. If we can help along the way, don't hesitate to reach out. Mark, obviously a lot of folks hearing about the momentum, the excitement around this SpaceX IPO. Obviously, a lot of real business being done underneath that. How do you evaluate what's going on here?
Yeah, one of the trickiest things, Rob, for a lot of individuals is separating the idea of what I think about the company versus what I think about the stock of that company as an investment. And so in this particular case, you've got a company that has a lot of exciting things in it. So the Starlink business is a really great business. It's growing. It's making money. You've got the robotics angle, the space angle, of course, the Elon angle. But when we look at SpaceX as a stock, the company as a whole has yet to turn a profit. So it's an unprofitable business at this point that's being valued as the fourth largest company in the United States. It has just passed in less than a week Amazon and Microsoft, a couple of our biggest growing, most profitable, most recognizable companies that have been around for decades. And so you can't help, if you're an older investor like me, but think back to the dot-com bubble. And about a year after that bubble started to burst, one of the darlings of that era, Sun Microsystems, the CEO was talking to a bunch of analysts, and he was walking them through how ridiculous it was that investors had priced his company at 10 times their current sales. And he ended this little speech with, "What were you thinking?" In other words, what were you thinking paying 10 times our sales for this stock? Well, SpaceX is currently priced at over 100 times their current sales. So if 10 times was ridiculous then, what is 100 times? I mean, this is pretty mind-boggling on the valuation side. So I would just caution any listeners who are thinking about investing in SpaceX, not saying don't do it, but I would say history shows that a lot of these big, high-profile IPOs often trade as much as a third to half of the price of the IPO price within the first 6 to 12 months that they're public. Now, we have no way to know if that's going to be the trajectory for SpaceX, but history shows it's not unlikely. So you may get a better shot, or at least a shot at SpaceX at a better price if you're patient. So those are kind of my thoughts there, Rob.
Yeah, interesting. Well, we'll certainly keep an eye on it. Obviously, something else going on this week, tomorrow in particular, the Federal Reserve is going to wrap up its policy meeting. This is a big one because the central bank's Federal Open Market Committee is going to release where the individuals on the committee expect interest rates to head. It's also the first meeting of the new chair, Kevin Warsh, and apparently he may withhold his dot, I'm hearing, from the dot plot that they've become famous for to predict where rates may be headed in the future. But what are you expecting to come out of tomorrow's meeting?
Yeah, I expect that they're going to hold rates steady. They have had, earlier in the year, they had what's called an easing bias. In other words, they were communicating they were more likely to cut rates than raise rates. And I expect that if there's a change, the change will be the removal of that bias so that the committee is telling the public that we're equally likely to raise rates as cut rates. Now, between you and me, Rob, I think that if we get a resolution to this Iran war, that will be short-lived. It's very hard for me to imagine that they will be raising interest rates if we have a resolution to the war, and I would not be surprised if the next move is lower in that situation, although I don't expect that they'll be either cutting or raising anytime real soon.
Yeah, that's helpful. We'll certainly have to keep an eye on inflation, of course, but just given what's going on with this market momentum and earnings, I mean, earnings have been they've been knocking the cover off the ball, haven't they?
They really have, and we've been getting strong economic data. The jobs report 2 Fridays ago was really what caused the market to swoon there for about a week, because the idea that if the economy is hotter than had been thought, then that is a sign of potential overheating and more inflation and making the Fed more likely to raise rates. So you do have kind of a brew here of different events, but all told, more jobs is good, strong economy is good, rates aren't that high, but investors get spooked when the Fed is talking about raising rates.
Yeah, really good. Mark, let's come full circle to where we started with the bubble talk. Bring this home for us. When people start talking about market bubbles, what should investors keep in mind at the end of the day?
I think the bottom line, Rob, is you really don't want to let fear or excitement drive your investing decisions. Markets can stay hot a lot longer than people expect, so trying to guess these exact turning points usually creates more problems than it solves for investors. I would encourage listeners to follow the age-old basics. Stay diversified, rebalance periodically, keep reasonable expectations, and most of all, focus on a long-term strategy that you can stick with through all different types of market environments.
Yeah, very good. I think that's well said, Mark. And of course, folks can head over to SMI. Not only can they engage with your private market group or private client group if they want to delegate to an advisor, but the SMI newsletter can give them the kind of DIY selections if they want to pick their own funds. Is that right?
Yeah, that's exactly right. That's what we're trying to do every month is give people the general knowledge like we've been talking about, but then the very specific recommendations of exactly what they can do in their own portfolios to navigate these crazy markets.
Yeah, and a lot of our listeners take advantage of that. Mark, we always appreciate your time, my friend. Thanks for being here.
It's always my pleasure, Rob.
That's Mark Biller, Executive Editor and Senior Portfolio Manager at Sound Mind Investing. If you'd like to read this article we've been talking about today, just head to soundmindinvesting.org. Click the article that says How to Handle a Bubble. You can also learn more about the Private Client Group and the SMI newsletter at soundmindinvesting.org. Big thanks to my team today, Omar, Tahira, Taylor, Josh, and everybody here at FaithFi. Faith and Finance Live is a partnership between Moody Radio and FaithFi. Come back and join us tomorrow. We'll see you then. Bye-bye.